Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show is geared towards getting you insight on everything money related. And today I'd like to talk about mutual funds, but I'd like to introduce something that I want to bring to you on an ongoing basis, and that is Know Your Fund Manager. It is an attempt that we have to bring you a little closer to the people that manage your money, and I want to get the story behind the fund manager as well. And to that end, the first fund manager that I want to introduce to you on this set program is Chandraprakash Padiyar, who's a senior fund manager at Tata Mutual Fund. Chandraprakash, thanks so much for taking the time. Now, ordinarily, I'm sure on interviews such as this, we start directly with your philosophy and various other things. But I do want to talk about your journey to this point, because it's been 24 plus years and you've done quite a bit in that time. I want to understand how your current philosophy when it comes to portfolio building has been distilled over that period of time.
So hi Alex, and thank you so much for having me on your show. Well, it's been an interesting 24 years for me, obviously. Learned a lot, still learning though. And I would say, so to answer your question on current philosophy, our current philosophy is, or let's say, I would actually rephrase. I've been managing with this philosophy even in the previous organizations where I've worked. So philosophy has been, so in a sense, Tata Mutual Fund, the stars aligned in the sense that the philosophy remained the same and the way of managing money remained the same. So it's just that you are more, let's say, from experience, you are more disciplined in your approach. You've learned a lot and applying that on your investment thought process.
You've you said 24 years, so therefore you've already witnessed several market cycles, and I guess what you're saying makes sense. That kind of reinforces the processes that you put into place. So let me get into that then. Growth at a reasonable price seemingly is the overarching framework that you have, but can you describe that to me? How does that result in the portfolio building approach that you have?
Sure. On growth at reasonable price, basically you are looking for company on theoretical basis. You are looking for companies which can grow at a fast pace consistently over a long period of time. Basically, you're looking at scale in businesses that you buy. The second aspect, or an indirect or direct and indirect aspect of this, is that you are looking at long-term investing. So you buy today and let's say hold for a longer period of time with the assumption that the management team on which you're betting on will deliver consistent growth over a period of time. My learnings of the past 24 years, one of my learnings is that the longer the scale up or longer the time with which the management can scale a business, the better it is for the market, or the faster you get your re-rating over a period of time in terms of valuations. So growth at a fast pace is very important. Consistently at a fast pace is very important. The second thing that we've learned along the way, and this is more around 2008 or post 2008, the way the world changed, is that along with growth, you need to focus on free cash flows. So businesses which can deliver cash on an annual basis, basically your balance sheet quality is very strong. You do not need, or companies that you invest in, barring financials, do not need to raise capital very often from the market. They can fund their growth on their own. That's the critical aspect that, and has been one of my key learnings over the last 24 years. So one is growth, second is free cash, and lastly, this combination of growth and free cash needs to come with reasonable valuations. So, and over in your investment horizon, for a part of your portfolio, we aim for re-rating of valuation, and this is something that it comes through. So this is where art comes. So one is the growth part and the free cash flow part, that is science, which is mathematics in terms of numbers. The art is to identify businesses at a time when the market is probably ignoring the fundamentals of many of these companies or management teams. You buy it at a time when everybody is either negative on, or most people are negative on the business or not looking at those businesses favorably. You buy them, so you get it at a cheaper price. And as and when those come, and you buy them at an inflection point or closer to an inflection point, So you get it at a reasonable price or valuations. And as and when these businesses deliver earnings over a period of time, the market realizes that the quality of the business is good, management quality is good. It is just that short-term period the company didn't do so well. You get re-rating of valuation. So this is the combination that we look for in growth at regional prices in investment philosophy. Now, this is something that we apply to funds in a shades of gray, in the sense that a different fund will have a different variation of growth at regional price that you apply to.
Okay, and we'll get into the details of a couple of schemes that you manage, which is one, the Tata Small Cap Fund, and also the Large and Mid Cap Fund. But before we do that, I do want to get your opinion on where things stand right now. There's so much noise on the global stage, I'm asking what you would be focusing on right now, because between September and March, Chandraprakash, you would have gotten opportunities based on your philosophy, I'm sure, to buy companies that would have been relatively resilient and valuations had corrected from those heady levels that we saw in the run-up to those all-time highs. So talk to me about some of the opportunities that you saw and that you took advantage of.
I will give you an answer in two manner. One, when an interesting example that I want to start with, and it's quite interesting actually, is that in the past 24 years, for example, on an average, we used to always assume that rupee will depreciate against the dollar, depending on the inflation differences, with the normal theoretical that we've been looking at correlations and all. So rupee has depreciated, let's say, around 3% CAGR for many decades. But interestingly, for example, this week, what we were doing internally, at least in my portfolio that I was doing, is I was trying to check that what if rupee were to appreciate for a short period of time. And let's say, and this is just a what if, it may not happen. It's just that given the world environment the way it is, we are reflecting on the fact that we are re-looking at our portfolios in both the funds and saying that what kind of portfolio or what kind of businesses do I own, and if rupee were to appreciate by a large manner in a short period of time, what happens? Am I taking too much of a risk? So that's that. So your question was very valid. Is that these are uncertain times. Many past hypotheses or many correlations of the past are changing, and we have to almost every day think of the risks that we are taking in incremental. So coming to this, your question specifically. Let's say, for example, today, and you would notice this as a clear trend in both the funds that I manage, which is Tata Small Cap Fund and Tata Large and Mid Cap Fund, is that a large part of the portfolio, or a very large part actually, is more domestic oriented businesses. We do realize that there are incrementally a lot of uncertainties coming up almost every day. And last 6 months have been unusual actually. Though the market price, the stock market doesn't show you that as of now that there are any uncertainties in the business environment, but on ground we do see lots of uncertainties developing almost every week, every day. And it is quite logical for us to have more domestic companies because India as an economy, or specifically for India specific businesses, domestic market, we are seeing interesting, healthy signs actually, or things picking up from where we are today incrementally. We are more optimistic on domestic businesses, and that is what you see in our portfolios.
Okay, now let's get into this one by one. I want to talk about the small cap fund first. I've always been, I've always looked at your decision to restrict inflows when you did into the small cap fund as a brave move and a valid move in the context of your assets under management versus some of your peers, which are significantly larger. So first, talk about that. That is still in place. You have lump sum investments that are not allowed, and SIPs continue to go through. Why is it that it's still in place?
So the rationale of stopping or to stop taking lump sum money was that in very short periods of time, in let's say in June 2023, when we did stop this, early between Jan and June of 2023, in a very short period of time, we were getting very large amounts of incremental money in the fund, given that performance was good and small cap generally were in favor. we thought that taking large sums of money in short period of time creates issues for the fund manager to deploy that much capital at a time when market was in a bull cycle. And it is negative for existing investors. So, in the interest of existing investors, we chose to not take or stop taking lump sum money and continued with the SIP money so that existing investors continue to put long term capital to use. Why is it still there? I have one is that generally speaking, and this is a fact for our market, valuations across the market, whether it is large cap, mid cap, or small cap, valuations are either fair or slightly higher than normal, which means that your incremental risk reward is not as good as what it used to be in the past. So one is a fundamental view that incrementally return expectations for investors needs to come down because the risk is increasing. And two, on the second aspect is that small cap specifically as a segment inherently is illiquid relative to large cap and mid cap. And when, if let's say, for example, we manage the early part of the question, we manage our money with growth at reasonable prices and investment philosophy, where we are choosing specific businesses, buying in with conviction for long term, which means that we are in many ways buying 3% or more of equity capital of companies in many. So let's say 25% of my portfolio in Tata Small Cap Fund approximately is in companies where I own either 3% or higher of equity capital of that company. Now, if the fund size keeps growing, we as an investment team will keep increasing our weightage in businesses because the money is coming in a large manner. So illiquidity of the portfolio goes up quite significantly. And to continue to manage from our investment thought process perspective, we thought that it is best to take gradual capital rather than lump sum capital in one go, and hence it is continuing in this manner even today.
Okay, great. And that makes complete sense. I've also noticed that your churn, and just so that everybody understands, the degree of change of portfolio and the kind of selling and buying of stocks is not very high. So that fits in with the philosophy that you have, which is you invest in a set of companies where you see growth in cash flows and you expect that is going to play out over a period of time. So that point is well made. Can you tell me about, and you referred in your last answer, Chandraprakash, to your anticipation of earnings, and you said that moderation of returns is appropriate at this juncture from the investor's perspective. So where do you peg the earnings heading into the new financial year? Because you have estimates that have been brought down from mid-teens to closer to around 10% or 10, 11%. Is that what you think as well?
So one is, so what you're referring to is the benchmark indices earning growth.
200 plus.
Yeah.
200 plus, yeah.
Which is generally the benchmark indices, less than
correct.
50 or BSE 100 or BSE 200. But what I see is that we are likely to see, starting this year, we are likely to see very high divergences in earnings delivery by businesses across sectors. What I mean by that is that, see, for example, in the last 4 years, for example, let's look at FY 2021. At that time, if I remember numbers correctly, corporate profit to GDP, more from listed angle, was somewhere close to 2%. We are today somewhere close to 5.3%, which means that, and in the previous peak, let's say in 2008, that same number was 6.8. So we were very low in 2020-21 at around 2% of GDP. We have now crossed that number and we are at 5.3. We are still lower than our previous peaks from a profit perspective, but we are closer to the higher levels, which means that your one, aggregate profits cannot grow at the same pace at which it grew in the past. And two, not all businesses will be able to grow at the same pace. Obviously, at a time when global growth is likely to slow down, we just saw World Bank reducing global growth estimates, including the US. It is very logical to assume that you should expect large divergences in earnings across sectors, across businesses, across market caps, which means that on an index level, given that indices are very diversified, BSE, you mentioned BSE 200, for example, there are 200 companies in there. Not all 200 companies will be growing at the same pace. So it is a stock selection market. So it is good for people like us actually, for fund managers like us who are more business specific, who buy limited number of companies focused on delivery of earnings. So to answer your question, there are businesses today available in our economy, more domestic focused, where we do believe that incremental one, maybe some to some extent base effect also for some companies. To some extent, some companies have done something very good in their business, which is leading to high growth. Uh, but let's say both Tata Small Cap Fund and Tata Large and Mid Cap Fund, we do think that there are a fairly large part of the portfolio where profit growth is likely to be very healthy, in excess of what the numbers that you mentioned.
In excess of, sorry, I just want to ensure that I have the right understanding. So what, better than expected would be around 15% or more than that?
More than that. That's so obviously we can't.
Of course, you can't quantify that. You can't quantify that. But yeah, yeah.
But we do sense that our view is that there are some limited number of companies available in the market today. If you choose them well, profit growth is likely to be very healthy. And but having said this, I also have a view, and I started, for example, in our conversation when we started this, I did say that generally in our markets, valuations are either fair or slightly on the higher side, which means in a world where you see divergences, you see slowdown in earnings, it is logical to assume that valuations it should derate to some extent. So even you see, it is very important for you as a portfolio manager today to have high growth companies, because even if there is derating in valuations to some extent gradually over a period of time, your absolute returns is still delivered to some extent. So that's the way we are thinking today, is that we are in a world where return expectation needs to come down. But to answer your question, I think if you choose your stock well, I think earnings delivery is still there.
Okay, let's come to a stock selection. I want to focus first on the small cap fund. 58 stocks. Some would argue that it's a pretty small holding compared with certain other peers where you have 150 plus 200. But without comparing with your peers, help me understand what the allocation is like, because it seems like you've reduced your allocation over a period of time to IT. You've gone underweight. Financial services also, and I'm looking at your presentation here, it's not overweight at least. So help me understand how you're positioning as things stand right now.
So one is on the number of stocks perspective. I would say that in 2024, first to give you a background, in 2024, when the market were in the bull market situation, when everything was going up, we were busy changing our portfolios. So we were busy booking profits and replacing it with our philosophy of stocks where we thought market is ignoring. So we were actually doing many changes in the portfolio. But what did happen is that we thought this bull market may probably last longer. So we were taking our time in booking profit gradually. In the process, there are, for example, as we see today, out of the 58 stocks that you mentioned, there are more like 15 plus stocks where I have a weightage of either 1% or below 1%. Normally, we don't like to buy businesses, so we don't like long tail. So then the correction stepped in, and we thought that doesn't make sense to sell now. These businesses are still good. So we are retaining a long tail as we speak. So 58 looks lower, but in my mind, we are working with 40 stocks actually. So that's one part of it.
On the financial services, which you're significantly underweight, I'm curious why that is, because everybody that we're speaking to is looking at financial services and saying this is going to be the leg of growth.
So I would tend to agree. For most banks, I would not say financial services. I would more focus on banks.
Sure.
Mid-size and small-size banks, given the base of earnings that they are sitting on, let's say starting or FY25 and first half of FY26, it looks like that second half FY26 onwards, most of these small size and mid size banks will start growing earnings at a higher, faster pace if they deliver on credit cost as good as what they've been delivering till now. And valuations are on the reasonable or cheaper side. So I would say that yes, it does look, or there is a merit to consider some of these banks, which we are. But our view is that from a banking sector perspective, if I have to buy and hold for a longer period of time, small size doesn't help in banks. Ultimately, capital is the raw material, and a smaller size bank, or even to some extent some mid-sized banks, getting consistent capital from the market is
Yeah.
not going to be easy unless until you start trading at very high levels. So, which is why we've always taken a very low exposure or very small exposure in financials or banks in our portfolio. We're not. We would rather play the mutual fund space than the bank space. That's the way we've been playing it.
In the small cap portfolio, and but and so therefore, just to drive home that point, large and mid cap portfolio actually are overweight on banks. So that drives home that point. So you think that the large banks are the best play in the banking space right now?
More consistent, and you can rely on them.
Got it. Now, what is your opinion on chemicals? Because I see in both your small cap and in your large and mid cap fund, you are relatively taking a larger bet on chemicals. Why is that?
So to step back, I would say that it is not a sectoral view.
Okay.
And it is certainly not China plus one view.
Okay.
We have bought very selective chemical businesses where and all of them are either domestic oriented businesses, barring one, which is wherever they have, so they have more like 18 factories across the world. And wherever they have a factory, they supply to their own local market. So they are not at all working on global businesses and all. So in that sense, we are more focused on or have bought businesses where we think they have some or the mix of the business that they run, we think sustainability of growth is there and they can generate 18-20% plus return on capital employed and valuations are on the reasonable side. So a combination that we generally look for is what we have. So consistency in chemical businesses, there is, as you've noticed in the last 4-5 years, there has been very high volatility in earnings delivery.
Okay.
Whereas if you look at the businesses that we've bought, volatility in earnings is actually very, very low. So we are more happy with buying businesses which can keep growing at a consistent pace and where there is room for valuation re-rating rather than playing this high export story.
Yeah. And while we've been speaking, what we've been putting up on screen is your latest sector allocation, the top stocks that you have in both the schemes. So our viewers generally have a sense of where you are allocated. Just a last minute, and so therefore I do want to ask something that I tend to ask a lot of fund managers that come onto the program, which is, what is the messaging that you have to your investors and prospective investors as things stand, particularly to your investors?
So I would say that be cautious for FY26, but be very optimistic for 27, 28, 29 or beyond that. That's the way today I see things. I think the way the world is, things do look challenging incrementally. I hope things turn around quickly. Doesn't look like that way right now. So in that sense, very short-term view on the cautious side. But if you take a medium to long-term view, India genuinely has a large role to play in growth. So there are quite a few businesses which are likely to grow at a reasonable pace, and valuations hopefully over a period of time will normalize, which will make a case for reasonable returns for investors to make. So that's the current thought in my mind.
Fantastic. A pleasure having you on the program. Thanks so much for taking the time.
Thank you so much, Alex, for having me.
All right, so that was Chandraprakash Padiyar, and that was also Know Your Fund Manager. You know him better than you did yesterday. Now, I also have an interesting data set, or rather 3 interesting data sets, so that you can understand how the performance of large cap, mid cap and small cap funds have been. And if I look at the performers over the last 1 year, the outperformers actually have a story to tell. So first, let's look at the large cap outperformers. The top of the list is Motilal Oswal Large Cap Fund. It has returned 24.6%, and the outperformance to the benchmark is at as much as 16.1%. Now, traditionally, you've said that active large cap funds have not beaten the benchmark, but this one has managed to do so in a big way. And what has worked for this fund house has been the utilization of the 20% allocation to other stocks beyond large cap, and some of their stock picks have done incredibly well. DSP is an interesting story as well, because there's one significant absence in the top holdings, and that is Reliance Industries. Over the last 1 year, Reliance Industries, though it has caught up in the recent past, it has been a relative underperformer, and that has done well for DSP as well, 17.2% return and an outperformance of 7.7%. The others, good performance and outperformance as well, but this is par for the course. Good stock selection. Now, in the mid-cap space, there are a few interesting names that come through. Invesco has done well, 19.3% growth over the last 1 year, outperformance to the extent of 9.5%. You have Motilal Oswal again, but do note that over the last few months, this fund has not done very well. In fact, it has held an elevated cash position because a couple of the stock picks that it made didn't turn out as anticipated. But you have Nippon India, you have Franklin, you have Edelweiss, and also in the small cap category. And the reason I'm clubbing these two is because you have a few names that stand out. You have Bandhan Small, you have Invesco, once again, Motilal has done well, and you have UTI and Axis. So what seems to be the case is that over the last few months, when the market has seen a bit of a correction, particularly at the broader end of the spectrum, those schemes that have a quality bent have actually done relatively better because they've afforded you more downside protection. Do remember that these data points are meant to tell you what the scorecard is for the last 1 year. But that's not necessarily going to be the case going forward as well. So make sure you look at the longer term performance of these schemes. 3-year, 5-year rolling returns would be a good way to look at it. And we'll do that over the course of the coming days and weeks. That brings us to the end of this edition of Your Money Matters. Hopefully you found it useful. Let us know what you think in the comment section and do stay tuned. This is NDTV Profit.